What if a country isn't actually broke, but simply running out of time? A nation where every dollar spent today is borrowed from tomorrow, where survival doesn't depend on growth, but on the next loan approval. This is Pakistan, a country surviving on borrowed time. Pakistan's economy isn't collapsing overnight. It's slowly tightening like a pressure cooker. As of recent years, Pakistan's external debt has crossed $125 billion, with a large portion owed to global lenders like the IMF, World Bank, and bilateral partners. But the real question is, how did it get here? Decades ago, Pakistan had potential, strong agriculture, growing industry, and strategic importance. But instead of building long-term economic engines, the country relied on short-term borrowing to fund growth. Loans became a habit, not a solution. Over time, each government borrowed more to pay off previous loans, stabilize currency, and cover deficits. Pakistan entered multiple IMF programs, over 20 times in history, making it one of the most frequent borrowers globally. But every bailout came with conditions. The real issue wasn't just borrowing, it was the system itself. A weak tax structure, where only a small percentage pays taxes, heavy reliance on imports instead of exports, and a political cycle that prioritized the short-term relief over long-term reform. By 2022 to 2023, things got critical. Foreign reserves dropped to levels barely covering a few weeks of imports. The Pakistani rupee lost significant value. Inflation surged beyond 30%, and the cost of living exploded. For ordinary citizens, this wasn't just economic theory. Food, fuel, and electricity became unaffordable. Power outages increased, and businesses slowed down. The crisis moved from spreadsheets to real life. To avoid default, Pakistan turned again to the IMF. But these loans came with strict conditions: higher taxes, subsidy cuts, and currency devaluation. Short-term survival, but long-term pressure. The pattern kept repeating: borrow, repay, borrow again. Instead of fixing core issues, exports, taxation, productivity, solutions remained temporary, and every cycle made the debt heavier. Pakistan isn't alone. Countries like Argentina and Sri Lanka followed similar paths: high debt, weak exports, repeated bailouts. The pattern is clear. When economies depend more on loans than production, collapse becomes a risk, not a possibility. Today, Pakistan hasn't defaulted, but it's walking a very thin line. Growth remains slow, debt payments are rising, and every year brings the same question: can the country break the cycle or just delay it? 3 takeaways. First, debt isn't dangerous, dependence is. Second, short-term fixes can create long-term traps. And third, economic survival requires structural change, not just loans. Because in the end, the real question isn't whether Pakistan will survive, it's how long it can keep borrowing.